Here's a stock which has been super volatile over the last 7 quarters of earnings that it's declared. In 5 out of the last 7 quarters, when it's declared numbers, the stock has fallen 2.8% or more. In fact, at times we've seen huge volatility. In the two times that the stock has actually gone up, it's gone up over 5.5% one day after the result. I'm talking about Axis Bank. So why has this been a problem for Axis Bank? Because every time they've guided for something, they either haven't delivered or have over delivered on their guidance. That's where the concern lies. There's no consistency of performance that Axis Bank has delivered. uh, when you're talking about this quarter's numbers, what has disappointed? The provisions number, the provision on bad loans that the bank normally makes, was expected to come in at around 2,200 crore. It came in at 3,900 crore. Now, it included some one-offs, and I'll talk about those one-offs, but 800 crore of one-offs. So even if I exclude the one-offs, it's not like the provisions number was anywhere close to the expectations, right? That's where the primary concern of the market is. Where is this provisions or where is this provisioning coming from? It's coming from retail loans. Now, retail loans are granular. Ideally, large provisioning on retail loans is not a good sign. So that's exactly what the street is worried about. The stock tanked 5%. Now, mind you, this is India's third largest private sector bank, and the stock has tanked 5%. Okay. Now, let me also talk a little bit about what the change in provisioning norm was. The change in provisioning, which led to an additional 800 crore of provisioning that happened in this quarter, was because of something they call technical write-off. This is basically an accounting change they've made, where they're recognizing bad assets conservatively upfront. But well, you'll say that's good, right? The bank is being conservative. But what the street is saying is that you've basically diluted the book value and the profitability of the bank upfront, right? Whether that's warranted or not, from a conservativeness standpoint, either way you've done it. If it was warranted, you should have done it a long time ago. If it isn't warranted, then why have you done it? That's what the street is really concerned about. So 5% lower on this stock, one, is not a surprise because we've seen immense volatility on the counter for the last 7 straight quarters. Now, on a day like this, you'd see profitability really impacted, but we didn't see that. Profits were down maybe just 8 or 9% below estimates. So why is that the case? Because other income was a firm beat. Other income grew 25% YOY. So that was a strong beat. And what we saw is operating expenses were sharply lower than expected. So your OPEX was lower, your operating profit therefore was a beat. But all of that got nullified because of the excess provisioning that has happened. For the first time, Axis Bank achieved a 1.8% ROA in a while. Axis Bank achieved a 1.8% ROA in Q4 FY25. All of that good work undone in Q1 FY26, with the ROA falling to 1.47%. And even if I adjust for the one-off provisions which they've made, the ROA is not much higher than 1.6%. So it's not really very close to their target ROA of 1.8%. Now the other piece is margins, and this will actually impact even some of the other banks, some of the larger private sector banks. Margins have taken a tank. From 3.97%, margins came down to 3.8%. The bank has always guided that across cycles, our margins will be 3.8% plus minus. Now, when you're looking at it across cycles, if 3.8% is the benchmark, this fall has been fairly sharp because you have a 25 basis point repricing, which has already happened, but a 75 basis point repricing, which is the latest two cuts in the repo rate, which hasn't been priced, which means that margins will fall further. Margins are technically the difference between your interest income over your interest expenditure, and it basically gives you the amount that the bank makes on the AUM. So if the AUM growth is 14%, If 3.8% is the margin, you get a typical understanding of what the bank makes. That's the spread broadly of the bank, or indicative of the spread. So what you want to see is how much will this fall further. Maybe Q2 will be a better reflection of where it will be, but you want to keep your eye out on this one, because if the margin falls sharply in Q2, you might well see that impact affecting numbers going forward as well. I'd urge you to look at your portfolios, check whether you have Axis Bank, try and understand exactly what the results are. And if you don't have a portfolio, if you have a mutual fund, go check that. Check whether they have Axis Bank, because if it impacts your mutual fund, it impacts you.